earlier in the show, we had a different David Kostin from Goldman Sachs, telling us that he was really disappointed about not getting enough earnings guidance forward-looking during this earnings season. Where do you see the downside pressure coming from?
Thanks very much, Sherry, for having me on the show. We are generally still constructive on global markets, including the U.S., but we'd agree with that other David that the earnings guidance so far has been opaque. And I think it reminds us that although a lot of the selling pressure we've seen to start the year has been driven by the 10-year yield, we need to recognize also that there are really two risks out there this year. There is obviously the inflation and rates risk, which I think is now well understood, but also the other one of conviction on earnings growth. And I think the opacity of that earnings guidance really reminds us that there are a number of sources of earnings risk. So just very quickly, one would be the lockdown business fatigue. Companies like Peloton that have come under pressure in recent months. You have the slowing of the anniversary of stimulus checks. You've got normalizing supply chains that reduce pricing power for certain businesses, margin pressure from labor prices going up, and then, of course, there's the risk of war, which we've been hearing about in recent days.
Dave, just hold on for a second, because we are getting the Monetary Authority of Singapore's monetary policy statement right now, and they're now further upward shifting their inflation outlook in Singapore, saying that they're revising forecast for 2022. Core inflation is now projected to be 2 to 3% this year. CPI all items inflation is expected to be 2.5 to 3.5% this year, and that the Monetary Authority of Singapore sees that will be appropriate to make another preemptive stance adjustment. Dave, going back to you, really these inflationary concerns seem to be pretty worldwide, and even MAS having to adjust their guidance on price pressures. How much of that has been already priced in by the markets?
Well, when you hear people like Professor Siegel speaking earlier about the rates being lifted up to 2%, then obviously people are already starting to make very hawkish predictions of what happens to monetary policy. But I think from an equities perspective, it is important to remember that what has been driving the value versus growth debate in certainly U.S. and global equity markets has not been the 10-year yield per se, but actually the shape of that yield curve. And if what you believe is that the 10-year, which we can see is actually still off of its highs, doesn't go up too much further, maybe up to 2, whereas we get a lot more rate hikes between now and the end of the year, that suggests a flattening of the yield curve, which is actually good for growth stocks. We recommend investors need to be disciplined on valuation, so avoid the unprofitable tech parts of the market, but one needs to strike a balance. And what we are suggesting is a middle of the road, actually, between growth and value, where the most important thing is quality and the predictability of earnings, because that's actually the X factor that we can control as portfolio managers and investors.
David, we are continuing to get a little bit of information from the Monetary Authority of Singapore, MAS, just saying it will therefore slightly raise the rate of the appreciation of its policy band. The width of the policy band, though, and the level at which it is centered is going to be unchanged as the MAS looks to ease slightly. Well, anyway, let's get back to what you were talking about. In the environment that you just sketched out for us there and the sell down that we saw today initially, do you feel like there were some quality names in that selling that offered a good opportunity for dip buys? Are equities still the only place to be if you're looking for opportunity?
Well, there is still this preference that we have for equities simply because of where rates and credit spreads are. It is, I think, the asset class that also tends to work better in rising rate, inflationary environments. But one has to accept the volatility that comes with it, as especially that monetary safety net that we've enjoyed the embrace of over the last couple of years gets pulled away from. So we do think that there are a number of interesting sectors and companies that are looking quite attractive today. One sector that we'd highlight in particular right now are some of the defensive ones, one of which would include global healthcare, which continues to trade at a 20% discount to the market. And, we think that some of the political risks associated with the sector are somewhat overblown.
Mm-hmm. How about a regional perspective as well? What's your weighting towards China and emerging Asia versus developed markets?
Well, I think coming into the year, there were a number of people that were quite cautious on China and on Asia, because of the economic adjustments going on in China, and also broadly because into a hiking cycle, one would expect a stronger dollar, which has generally not been good for emerging markets. But we've actually seen that a lot of that was priced in earlier last year, and that the dollar hasn't been particularly strong to start 2022. There is, I think, something of a decoupling of Asian economies from other parts of the world, in that they are earlier in the cycle of recovery. While there are certainly still risks in Asia as well, I think one can actually invest with a somewhat different lens. That's really why we favor more of the value trade, not just in China, but broadly across Asia for Asian equities at this time.